When I look at the big bank numbers, I see a lot of reserve releases, not much loan growth out there. I mean, were the numbers really as kind of good as the headlines seem to make them be?
Well, you're absolutely right, Brian. So remember, like the big banks set aside about $6 billion in loan reserves, and so you're absolutely right. They did release a lot of that because the consumer is strong, right? And so but there are a number of things. It's not just that, right? There are a number of things that actually did do well. In terms of loan growth, it's definitely mixed, right? So when you look at JP Morgan, loans were up 5% year over year. Citi, loan growth was flat. But then when you look at B of A and Wells, they had declines year over year, right? So, but that's not really what I'm excited about. I like, and I think I've definitely been on the show talked about this before. I really like diversified income from my banks. And so for me, I own JP Morgan, I own Goldman Sachs, and when you look at, and a lot of times, the trading revenue from those banks does really well, and so that's what we saw too. Trading was up, but really also the investment banking arms as well, right? So when you look at M&A activity, equity financing, right? We've had record-breaking IPO activity in the past 6 months, right? But M&A is huge. You see, the CEO of Morgan Stanley coming on and saying that. M&A is on fire right now. So that was really also driving revenues too. And then the consumer is clearly strong. Yeah. They're paying off their debts.
Well, money is cheap or even free. The bankers just sitting around on Zoom with nothing to do, and so they're going to do what bankers do, and that is make deals. But I appreciate you throwing that point out. The core business of these banks didn't appear to be that great. It was a lot of those reserve requirements. But if you're talking about another type of banking, investment banking, which it sounds like you are, you think we should look at more pure play investment banks, names we don't talk about much, the Houlihan Lokis, the Paul J. PJT, Paul J. Taubman's, a former 30-year Morgan Stanley lead banker, now with his own firm.
Absolutely. And those are like the smaller independent banks, smaller in comparison to like a JP Morgan or Goldman Sachs, that are doing really well. And they're really focused on M&A activity. And when you look at a company like Houlihan Lokey, definitely focused on M&A, finance restructuring, and really strategic consulting for some of these other companies. And they also acquired a GCA group for about $595 million just a little while ago. And so that's done really, really well for them. PJT Partners is another one. These stocks are doing really, really well. And I feel like they're really under the radar because everyone's focused on the big banks. And I own both of those, by the way.
Yeah, these are sort of the boutique banks as well that raise capital from around the world. They are pure play investment bankers. Because, again, you point out, you go into the numbers, Citigroup's net interest margin on its credit card business is like 5%.
Yes.
I mean, maybe it's time to shift from some of the giant banks to the mid-sized banks.
Well, I think in terms of, I don't think it's a shift, right? So I'm not coming out of JP Morgan and I'm not coming out of Goldman Sachs. I definitely like those. But when you look at financials, right, cyclicals clearly do well in our current environment, and also do well, particularly financials, in a rising rate environment. So while the Fed isn't raising rates right now, after it finishes tapering, we are going to be talking about interest rate increases, and so. Financial services companies do really, really well there because they're able to have expanded margins. So it's not just transitioning out of, it's adding to with these smaller independent banks.